Hello and welcome to World Talks with me, Ashim Kumar. Tonight we examine China's abrupt cancellation of high-level EU dialogues before the European Council as Berlin signals support for tougher trade tools against Beijing's overcapacity and subsidies. With Roland Freudenstein, co-founder Brussels Freedom Hub, we ask whether Europe can defend industry without triggering a damaging trade war with China. Roland, good to see you again.
Good evening. Thanks for having me.
Good evening. Pleasure to have you as always. So what is the meaning of the cancellations of these meetings by Beijing?
Well, it's a not so discreet signal by the Chinese government that they're willing to play hardball. But this is by far not the first time that we've seen such cancellations and pressure before decisive meetings of one or the other side, by the way. But the Chinese are especially good at signaling their frustration and their impatience with European trade partners.
What exactly are they frustrated about, Roland?
Well, the European Union is seriously thinking about doing something about the glaring trade deficit of 360 billion euros in 2025, a trade deficit in China's favor. And this in a situation where, like, just 6 years ago, right before the pandemic, trade was more or less balanced, even with a slight a trade deficit on the Chinese side. So, and we have a situation in which not only, but above all, in Germany, there is something like a China shock. A new China shock going on about deindustrialization through the sheer fact that China takes on more and more production functions and thereby jobs that Germany, Europe's biggest economy, is losing. I mean, the talk is about 10,000 per month of jobs that are that Germany is losing to China, and other European Union member states are also in, I wouldn't say panic mode, but highly worried that they're losing out in this increasing Chinese trade surplus with the European Union.
Right, as you say, I mean, Germany itself has a deficit against them with China of about 90 billion euros. Now, the thing is, what are the tools that the EU has to counteract this almost economic takeover by China of Europe?
There's a whole bunch of fancy names and labels and expressions used here. The latest one that's been floating around for the last couple of days is an overcapacity instrument. As part of the Industrial Accelerator Act, which is the European Union's big industrial strategy for the next couple of years. But part of that is to address China's overcapacity in several industrial sectors. And what we are basically talking about here are good old classical anti-dumping measures. In other words, dumping understood as a country in a strategic, planned manner offering goods below their actual production price or market price. And this is possible through a massive state financing, actually the government offering a financial mass to their own exporters so that they can undercut the price levels in the country of destination. And the instruments against this are, very tried and tested quotas. And if these quotas are surpassed, then there are tariffs. it's a bit ironic in some respects that the Europeans that always have told Trump and the Americans that they only shoot themselves in the foot through enacting tariffs against the Europeans, now are actually thinking about using that very instrument against the Chinese trade surplus vis-a-vis the European Union. So what we're really talking about are tariffs and certain automatic mechanisms that if a certain a price level is undercut, and if a certain quantity of goods is exceeded, then a new tariff, a higher tariff for the import of those goods will come about. So that's the essence of it.
Right. So, I mean, Spain is the only laggard at the moment that hasn't actually signed up for this. But there is a balancing act in the EU, because on the one hand, they are major proponents of free trade. And as you say, they criticize Donald Trump for his tariffs policy. On the other hand, they've got to protect their own economies. How are they going to square that circle in the European Council, Roland?
Okay, so after having pointed out the irony here, I have to defend the Europeans in one respect. The European trade surplus in industrial goods, not services, in industrial goods, vis-a-vis the United States, is not due to the same kind of dumping backed up by government financing, governments offering unlimited credit to their own enterprises. That is not taking place in Europe anywhere near the same scale that China is doing it vis-a-vis Europe. So that's a big and decisive difference. Now, as far as the European Union and the differences between its member states is concerned, very interestingly, Germany has, or is maybe about to, switch sides. It has already become more frustrated by the Chinese trade surplus and the Chinese trade techniques, I have to say. German business used to be the big believer in Wandel durch Handel, change through trade, so that, increasing trade with China would not just make Germany and Europe richer, but also would moderate the dictatorship of the Chinese Communist Party. Now, that has turned out not to be true. And in fact, as far as making Germany and Europe richer, part of German business has really woken up big time to the threats posed to precisely our own prosperity. And so that's the part of German business. We're talking steel, we're talking even car parts manufacturers that are raising the alarm bell. And right. They are telling Chancellor Merz, please do something about this. And just the last point here, it's only the big car manufacturers, BMW, Volkswagen, that have their own production facilities in China, are the ones that are still, stepping on the brake, quite literally.
Right. So that brings us to the next point quite smoothly, because, China's not going to sit back and accept all of this. How can they retaliate?
Well, they can make things tougher for those Europeans that still export to China or that produce in China itself. And here, these big car producers, mainly Germans, are in a squeeze because, on the one hand, their cars produced in China are partly re-exported to Europe, so they would be victims of the tariffs that the European Union could enact. And at the same time, the Chinese could do all kinds of damage to those European largely German car producers inside China itself. I mean, there are numerous torture instruments that the Chinese Communist Party can use against them. Just to take away further segments of the Chinese market to these European firms. So China can retaliate. China could even use the nuclear option, if you want, which they have used against Trump last year, which is just to say that, okay, you are largely dependent on rare earth minerals from China to produce mobile phones and so on. And we can simply strongly reduce or even stop altogether the export of those minerals. And it certainly worked in the American case because Trump suddenly became very conciliatory when it comes to a trade deal, which still is not done between the US and China, but is certainly much more probable than it looked like a year ago. Now, the Chinese could use such retaliation instruments also against the European Union. But, you know, in a situation where the trade balance is as it is, in other words, China has a huge export surplus here, a trade surplus, well, China is more vulnerable to a trade war than the Europeans. And I think we're becoming increasingly aware of this.
Right. Well, so it may well be that Europe is going to have to bite the bullet and take its chances if it's going to save its economy. But the economies of the EU. But what strikes me, Roland, as being difficult to understand is that we know what happened to the supply lines, when COVID struck. There were shortages all across the world. And so surely one would have thought that companies and countries would have learned their lesson not to be so highly dependent on China simply because they were cheaper to build there, because the risk was too high of a COVID-like event reoccurring. Why are companies still doing this?
Well, we have to distinguish between two sectors here. One is the dependence on concrete goods that we purchase from China or India or other countries. And these may be pharmaceuticals, these may be raw materials such as rare earth minerals, these may be energy, and de-risking from China, which was the big new buzzword 3 years ago, coined by Ursula von der Leyen, the president of the European Commission. De-risking means tackling those supply line dependencies and becoming less dependent on anybody outside, or rather to say shift dependency from countries that are more hostile to us politically to countries that are strategically more friendly, such as Canada, for example. Now, the other part of dependencies that we haven't tackled yet is the dependencies through our export markets. As I demonstrated in the example of Chinese possible retaliation against European exporters to the Chinese market, they still have substantial leverage on our ability to sell goods elsewhere.
Right.
When we, over the last 3 years, have talked about de-risking, we've always thought about supply lines.
Yeah.
We need to think about becoming less dependent on our export markets.
Yeah, understood. Roland, as always, unfortunately, the clock has beaten us again. But thank you very much for your analysis, and have a good evening.
Thank you. Same
Bye-bye
to you.
now. Cheers. And that brings us to the end of this episode of World Talks. Don't go away, lots more coming up. Goodbye.